Stocks. We're joined by Phillip Colmar, partner and global strategist at MRB Partners. It's great to see you. So you're a top-down advisory firm. People, big accounts around the world pay you for research.
Yes, yeah, pure independent research. Yes, exactly. So we advise some of your biggest pensions, hedge funds, multi-asset managers set the investment strategy for their global asset allocation or absolute return strategies.
And we hear that asset allocation is perhaps the majority of investment returns.
Yeah, it is. It's the big tilt. So we advise the CIO's offices on how to tilt their portfolios into which countries, which regional markets, or which sectors. So.
What's your view on Canadian markets? I know it's hard to generalize, but you're cautious?
Yeah, we're more cautious. We've been constructive on the global economy, the U.S. economy. I think it comes to a double-edged sword, though, with Canada. So I think people misplaced the recession bets on the U.S. and global economy earlier this year. We're unwinding that. So that's good in terms of growth conditions globally. It would be decent. The problem with it is it's also pushing up the 10-year Treasury yield. We're seeing bond yields rise significantly. And so we've broken out to new highs in terms of bond yields. So while that's been constructive on equities more generally, Canada's participated in it. Canada sits in a sort of a double-edged sword on that. It's good for growth that the world economy is stronger. We're not heading into an imminent recession. We leaned against those risks. Mm-hmm. The bad side of it is that Canada is sitting on probably one of the largest housing bubbles of all times. I've analyzed housing bubbles in the developed world, and Canada is really got unique one to its own. So it's got house prices to income ratios that are off the charts. It's got affordability that's very weak. And so it already saw weakness in the housing last year when we saw interest rates and mortgage rates go up. We saw some stability in that as we saw mortgage rates kind of calm down, go sideways, and then growth conditions firm up a bit. And so we are seeing some stability in the numbers right now. The problem is bond yields are back on the rise. They're being led by the U.S. and the Fed and U.S. Treasuries. But it's dragging up Canadian yields, means mortgage rates are going higher, and we will run into a risk zone. So we view Canada as a weak link to the global economy on the interest rate story. And there's some backlash to the Canadian markets, and particularly the currency as well.
I want to hear more about your views on housing, but why are bond yields going up? Are people worried about inflation?
No, yes. In 2022, it was an inflation and the Fed catching up, really. And so it led it up. And it was really every central bank, Canada as well. And so now we're starting to see a cresting in terms of inflation expectations coming down. We're seeing the Fed sort of go to the sideline. We're seeing other central banks looking to kind of take its exit as inflation kind of comes down or pause. The problem is that people had believed that we had broken the global economy with interest rates in 2022 going up. That was a mistaken bet. We didn't break it. The U.S. and Euro area in particular delevered. Unlike Canada, they delivered substantially over the past 15 years. They're a lot less interest rate sensitive economies. And so they've reaffirmed. And so the breaking point of interest rates is much higher than people think. And so what's happened is that as we've unwound the recession fears, we've pushed up bond yields. So bond yields are reflecting not necessarily inflation, although somewhat more sticky and longer-term inflation. I don't think inflation's coming down to the 2% target anytime soon. Mm-hmm. But we are getting erosion inflation. What it's reflecting is that we didn't hit that breaking point of the world economy, and bond yields, or the long end of the curve particularly, prematurely inverted. And so we're unwinding some of that.
So the flight to safety to bonds is to some extent dissipating.
Exactly. Yeah, it's unwinding. Exactly. And I think as well, there was real bets that we would see, particularly Fed rate cuts, but central bank rate cuts was at one point the back half of this year, then they got pushed out in the early part of next year, then the back half of next year. But we're sort of unwinding that. If the cost of capital isn't damaging the world economy at this point, then it needs to go higher. There isn't really a case. The Fed may go, or other central banks may go on hold as inflation kind of comes down. But rate cuts is a stretch when you think of the world economy not breaking under current rate conditions.
Now, I know that you're not going to give personal advice to anyone. You would never do that, but certainly not live on air. But if somebody has a house in an inflated city in Canada, you would suggest they think about selling it anyway. Yeah,
the problem with Canadian housing is it really got ramped up over, it's been 2 decades in the making, right? We had low inflation driven in the 2000s, for example, because of the commodity boom, drove up currencies and pushed down import prices. So it allowed the Bank of Canada to be more accommodative than it should have been. Then in the 2010s, after the housing bear markets in the U.S. and euro area, we had the global price setters dampening inflation. We had Bank of Canada playing competitive currency devaluation. So we ended up with, again, too easy accommodations, pushed up home prices. And the pandemic hits, and there's a case for it to burst. But we hit it again with monetary and fiscal policy, and so we inflated again. So you've had 2 decades in the making. You've got home prices that are very stretched. The worst part for a housing bubble is when you have a credit bubble underneath it. And the amount of Canadian leverage into the system versus incomes is pretty astronomical. And we've seen debt servicing going up dramatically. We've seen it's very hard. A lot of homeowners, they don't benefit from 30-year fix like the United States does.
Yeah.
So there was a lot of floating that got reset. There's a lot of other that are rolling over within 5 years. And we've been in a couple of years of this higher interest rate environment. So we have some risks in the situation. We see the Canadian banks really not wanting to allow it to topple. They've been trying to extend these things. But that's, in many ways, at some point it will. We've got Wild E. Coyote sitting over a cliff, and the bank's trying to hold the plank out to hold it up, but not to be too scary. But there is a risk, definitely a risk here, that if mortgage rates go higher or unemployment were to rise when we hit the next recession, then this thing does end up in a deleveraging cycle.